And I'm one of these sick guys who actually loves to talk about tax stuff. But it's what you can do with that. That's the important thing. Is if we can lower your tax bill, that's more money you have for your quality of life. That's more money that you can give to your family. That's more money you can give to the organizations and the causes that are in alignment with your value system. Yesterday I was with a gentleman who's worth $42 million. And so he was talking about estate taxes, and I was kind of the extra guy there. We were actually focused on something else. But he said, well, I've got to still pay estate taxes and all these things, and I just happened to chime up. I said, well, you realize that estate taxes are voluntary. Estate taxes are voluntary tax. You don't have to pay it. And you won't go to jail if you do something else instead. Todd knows. That's why we work together. And I said, oh, and by the way, capital gains taxes are voluntary too. You know that, right? And he looked at me like I was from another planet or I had 4 heads. And I said, no, it's true. Capital gains taxes are voluntary. You don't have to pay them, and you won't go to jail if you do something else instead. And this is a whole nother talk. In your flyers as well, you'll find an article. We write lots of stuff in our office. But this one's called, You Had Me at Capital Gains Taxes Are Voluntary. I was speaking to 60 commercial real estate brokers last year, and one of the fellows said, why are you here? Why'd you come today? He said, you had me at capital gains taxes are voluntary. I said, oh, I like that. Can I steal that? He says, by all means. But it's true. It's true. 1969, there was a tax act that America has always been been the most philanthropic country in the world. You realize that? It's one of the things I love about America. There are many things. Being married to a survivor of the killing fields like my lovely wife, we love this country because she's lived under the communist rule. She knows what it was like. The fact is, we live in the most amazing country in the world, bar none. We're also the most philanthropic country that has ever existed. It's also one of the things we expect our politicians to just stay married, to not do nefarious things. We have a standard. The French look at us and go, are you kidding? You mean our prime minister's got a mistress on the side? I mean, as Americans, we hold a different standard. There's so many things I love about America, but one of the things is we're the most philanthropic, and so it fomented with a tax law change in 1969 where Americans were given the opportunity to opt out of these various taxes if they supported the social well-being of the country in a way that's more in alignment with their own value system. Hi, Larry. One of the things that I love what Larry is doing here at Corporate Alliance is talking about how do we get our value system more in alignment with our business and where we're going. So if you don't know about Corporate Alliance, you need to meet that guy in the blue shirt over there. But again, the 1969 Tax Act created a whole bunch of tools, some of which I'm going to talk about right now. So I'm going to give you 5 ways to save on your tax bill. I've also thrown another 8. So if you want some more tax savings ideas, meet with any of our team back there. Team, Wealth Legacy Group team, wave your hands, that handsome looking group back there. So, and we'll get you the slide deck because I've got another 8 tax saving ideas that I'm just not going to have time to talk about. But anyway, so I'm going to give you 5. So the goal, I've got 3 goals for my presentation today. First one is to give you some ideas that will really, truly help you save big on your taxes today. As you heard, there's a myriad of changes, so you absolutely need to be in front of a professional like Steve's group to be able to make sure you're getting advantage of all of them. But I'm going to give you some so you can talk with your CPA, or if you don't have one, or if you're in the process of changing, go talk to Hutchison and Bloodgood. These people are phenomenal. I want to expose you to some ideas and strategies you may not have heard of before, or maybe you heard it and you forgot about it and it's time to be reminded of it. And the third one is I want to throw in, as I say, I've got 7 now. I actually realized I'm going to put 1 more in there as well. So get my presentation and you get some more ideas. And if you don't understand them, call us up, okay? Or send us an email and we'll meet for coffee. So this is the year. I've got this client. He just had a $42 million liquidity event earlier this year. He does his own taxes. Now, I gotta tell you, this is one of the smartest guys I've ever met. But you know what? I've got a master's in tax. We don't do our own tax returns. I use outside counsel for corporate and individual. It's just too complicated. You've got to get in front of people. So this is the year. If you have never used outside counsel for whatever reason, it's hard to believe. But I mean, here was this client of mine. So we're scrambling to try and help unring the bell on this huge liquidity event he had, the taxes that came from that. So this is the year when you get to need to be in front of somebody, especially if you have or will have a liquidity event with $500,000 of taxable gain or greater. You absolutely need to be sitting down and talking with competent outside counsel. Don't do it yourself. If you've had a change in your marriage, if you had a change in your business of significance, this is another year, or if you also have or will be receiving an inheritance of $250,000 or more, just you've got to sit down and have outside counsel, okay? And that's what we can help with as well. So first idea is, for how many people are involved in transactions or have had a transaction where you've sold an asset where you paid tax on that transaction? You sold a building, you sold an office park, you sold an apartment building, you're selling a business. Any of those ring a bell? Okay, most of the rooms. Okay, so here's a new idea. I was speaking on a platform for a conference with another friend of mine, and this was part of his talk, and I said, what is this? So this is a great idea. And it doesn't avoid the tax, but what it does is it defers it for 30 years. Now, how many of you out there, if you had to pay a tax and you had your choice between paying it now or paying it 30 years from now, how many of you would opt for paying it now? No hands. How many people would opt for paying it 30 years from now? Yep, every hand. Okay, so here's the idea. How many people have ever done a 1031 exchange where you sell something, it's appreciated, but you have an intermediary? Okay? It's awful. I've done them, they're painful, and I've never seen in my 30 plus years of practice, I've never seen a worse time to try to do a 1031 exchange than right now. Amen? Yeah. So here's an idea. So first of all, you have to understand what an installment sale is. First of all, that's where buyers and sellers, they agree to terms, come up with, okay, I'll sell, you buy for this number, there's going to be this amount of interest rates, payments, so forth and so on, okay? And it doesn't eliminate the tax, it just spreads it out in chunks. So as you get your income, you pay tax on a time. That's a traditional installment sale. Well, we're going to take that, we're going to put one more thing in between. Like we're going to put an intermediary. So we're going to have a commercial loan, but we're going to have an intermediary. So the seller and the buyer agreed all their terms, but the intermediary sits there, takes the money and holds the money, and the day after that money comes in, the next day, a non-related commercial lender makes a non-recourse loan to the seller. I said a lot there in a few words. What's non-recourse mean? Bill's wonderful. I've given up counting the number of loans we've done through Bill Birch. Every one of them successful, and not only that, but just a great friend. Bill, what is a non-recourse loan?
Basically means that the lender can't come after your personal assets.
Okay. How many of you have a non-recourse loan, like on your home, anything like that? If you do, I want to meet the lender. No, you have a recourse loan. They can come and take away assets if you don't make your payments, right? So this one is very different in a number of different ways, but one of them is because it's a non-recourse loan. So typically the seller gets 93.5% of the net sales proceeds. So in other words, if I know Dylan is a business broker, so he'll help you negotiate the sale of your company, help you get the best price, not leave any money on the table, and he needs to get paid for that. So again, fees for that of commercial real estate brokers, again, so but 93.5% is typically the net after sales proceeds that the seller receives, literally in days after closing. The one thing I love about this as well is that you can do it literally the day before escrow. Some of our techniques that Todd and I work on that are more philanthropic, you have to have months of runway. This one, you literally can do it the day before you close. In fact, you have to know who the seller and the buyer and the terms are, be able to use this technique. So this is a powerful one. So again, there's no taxable, sorry, my bride is saying, out of the way. Okay. So the no taxable gain for 30 years. You get the cash now to do whatever you want to. So one of the disadvantages when you're doing a 1031 exchange is that when you sell that property, you take your basis over what, again, when you have a building, you depreciate it out. So oftentimes when you're making the sale, your basis is next to nothing. And when you do that exchange, you're carrying over your old basis into your new property. So unless you've dramatically increased the market value of the purchase of the new asset, you got nothing left to depreciate because you already depreciated on the old building. This one, you've got 93.5% of the net proceeds to go and buy a brand new building with a brand new basis. If you want to do that, or if you want to use it to buy a motorhome, or maybe your spouse needs a new Lexus, fine, whatever, go do it. Make it happen. Make it rain. So, but this is a different way. Maybe you want to start a new business. Maybe you want to give more money away. Under the new tax bill, we can now, it's still deductible, but we can give cash away and we can deduct it at 60% of our adjusted gross income instead of 50% of the old law. So that's one of the changes, one of the advantages of the new tax bill. We can give more money away and get a deductible sooner. So that's idea number one. How about that one? If you left today and that's all you got, would you feel like you got something? Yeah, okay. Well, let's keep going. I can't wait. This one you've probably never heard of. You're going to probably hear, with the exception of a few like Todd and a couple others, but this is a powerful one. I don't think we've talked about this one yet. Private placement variable life. Now you can do this either onshore, what's called domestic, or you can do it offshore in one of the IRS approved sanctuaries, international sanctuaries. Typically we're going to deal with this when we're dealing with maybe $15 to $20 million estates or greater. Or one of the reasons, there are a couple of reasons why you probably haven't heard of this. One, because it takes $1 million. You have to put $1 million in either right up front or over time. You could do $250 a year for 4 years. But why would you do it and what is it? It's only for accredited investors. What's that mean? It means you have to have $1 million net worth, not counting your home equity. So that immediately rules out some folks. So some of your clients, this might not apply to. But again, what is it? So it's a insurance product, unlike any you've ever seen probably. Minimum funding, as I said, is $1 million. But instead, how many people have life insurance? Okay, good. My cousin Luigi is outside here, so if anybody is acting up, we're going to deal with you. But so this is, how many people put cash in your life insurance? Does anybody put non-cash in their life insurance? If you tried, you wouldn't have the life insurance anymore if you're using a retail product. This one, you can put cash, that's good. You could use stocks. You could pay your premium using stocks. You could pay your premium using real estate. You could pay your premiums using mutual funds or bonds. How many of you have that one? Okay. So it's a very unique, you cannot direct it yourself. You have to use an independent registered investment advisor like us. But why would you do this anyway? So what are the benefits? If it's set up properly in compliance with US tax law, the money grows with no tax. You can liquidate your portfolio. You can move assets around. You can sell real estate, pay no tax without having to do a 1031 exchange. How cool is that? It also, we do quite a bit of asset protection planning. So again, even though I have an in-house attorney, we don't draft documents. We get tons of referrals from law firms and CPA firms and so forth. But the point of it is asset protection. We do a lot in Nevada, 2-year statute of limitation there, but we do work in South Dakota, Alaska, other Delaware, and so forth. Those have various tails. In other words, if you move assets there, you can protect those assets after a certain period of time from unknown creditors. You can't protect it from known creditors, but you can protect it from unknown creditors. But you still have to work with a 10-year federal bankruptcy look-back rule. So in other words, if you have to go through a bankruptcy and you've given assets away anytime in the last 10 years, that money has to be pulled back. If you're using an international domicile, one of the IRS-approved international domiciles, it's a 2-year statute of limitations on everything. So 2 years and 1 day after you make the transition of those assets into that asset-protected trust, and all of a sudden you get a creditor comes after you that you weren't expecting, they can't touch any of the money. Completely offshore. In fact, the US government can't get at it either. Look at the Anderson case. If you want to read about an unsavory family, but it still had a very interesting outcome, read the Anderson case. He ended up thrown in jail because he had domiciled a bunch of assets in the Cook Islands. The US government went after him. They were the creditor. And finally, they realized even the US government can't get at those assets because they're domiciled internationally. Now, what's interesting is the trust was set up internationally, but do you know where the assets were actually held? US. Here in the US. But the wrapper around the assets was an international situs. So it's the Anderson case, Cook Islands, look it up, it's a fascinating case. But that set the international bankruptcy rules and asset protection rules. So again, this is, but again, back to this private placement insurance product, what's it do for you? It gives you the ability to access those assets if it's set up properly with no tax. So we've got clients with large amounts where we put in multi-million dollars that can use that as a way of creating an income tax-free stream of income for supplemental retirement income. So this is not something to do at home without, don't try this at home. And what's the key? When you buy real estate, Damien, what's the ground rules for buying real estate? It's location, 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 right? With international tax planning and asset protection, the 3 rules are disclosure, disclosure, disclosure. There are forms that Steve's firm will help you fill out. There are 4 different forms that need to be completed. IRS doesn't mind if we have assets domiciled internationally. They just want to know about it. You remember those cases that were in Switzerland, 300 families that were with UBS that got in big trouble a few years ago? Okay? The issue was not that they had these assets in Switzerland. What was the issue? They weren't reporting the income. So no wonder IRS was upset. And UBS wasn't reporting it either. So assets can be sold or repositioned without tax, accessible through contract, or what are called wash loans. Best asset protection you're going to find on the planet, as well as the lowest cost death benefit for other reasons I won't get into. And there's no commissions. So that's one of the reasons why this is incredibly competitive, because there are no commissions to be paid on it. We do this for a fee. So it may be a $50,000 fee, maybe a $100,000 fee. It just depends on the amount of money that's coming in and for how long. Yes, Jeanette.
So how do you use your real estate? Is it the equity in your property that you're using?
Correct. You can literally put a building in. Now, the tax rules are such that if you put an asset in that has appreciated gain, or again, there's gain that's in that stock portfolio, in the bonds, in the real estate, it can trigger a taxable event as if you had sold it. So what we do in case where there's an appreciated capital asset, there's a way we can get around that rule. We'll do it with some loans. We'll actually do some internal loans. What's ideal, though, is to actually put cash in there, use it as the seed bed to go buy your apartment building, buy your shopping center, buy your stocks, your bonds, but start with cash. That's ideal. Or maybe we've got some clients that use this as their fund, their incubator fund. So they'll put in $10 million, $5 million, and then they'll go acquire different companies that are starting out, but rather than using an incubator fund on the outside where it's taxable whenever there's a liquidity event, they'll have it inside this shelter where there is no tax and continue to spin it forward. So frankly, you'll see this a whole lot more on the East Coast. West Coast, we are a different group. Again, we're nouveau riche. This is new money out here. The generational money back in the East Coast and in the Midwest, Chicago, this is a very common concept. But for us out here, I'll ask somebody if they are aware of it, and it's like, never heard of it before. All right, got to keep moving along. Great questions. Thank you for these. Bunching deductions. So this is the year now again. So you had your exemption at $6,000 each. Now it's $12,000, which, by the way, is a great way. This is another way. If you, I've got clients of mine back in. This is one of the 8 ideas that's on my next slide that you're not getting right now. But I've got clients that have 2 boys going to private school in East Coast. They live in Texas. My clients live in Texas. They have a property a house. And the tuition for these kids is $25,000 a year, non-deductible. So it's $50,000 a year, non-deductible. So I asked him, "Are you paying the kids any kind of salary?" He said, "RJ, they're only 16 and 14." I said, "I understand that. You've got a rental house, right? You own a property back there in Virginia." "Yeah." "So why don't you hire the kids to maintain the house? They can get paid $12,000 and pay no tax federally. There may be some state stuff to deal with. But Steve can work out the details. So you can pay your kids $12,000 a year, 0 federal tax." How many of you are doing that? Now, obviously, if you hire your 4-year-old, or if you hire your wonderful 13-year-old niece, okay, we're probably not going to be paying her to be doing accounting kind of stuff that her uncle does. But so point of it has to be adjusted. But you can justify paying $12,000 for a 14-year-old pretty easily. It's deductible and non-taxable to them. So, but back to this. Bunching deductions. What's this mean? Now, again, you're going to get this $12,000. If you're married, that your spouse gets $12,000. So we're getting a much higher amount that's deductible. So many Americans are not going to itemize. They're going to give money, but they won't take itemized deductions because they've got this now higher $24,000 if you're a married couple. So what we're going to see and recommend doing is that you bunch your deductions and create more deductions in a particular year, and then those years you itemize. And the other years that you don't have all this stuff, then you go to a standard deduction, standard exemption. So, by the way, if you're 65 or older, or if you were blind or disabled, you actually get another $1,300 more if you are single, or if is it 16 and 13? I get confused on that one. But anyway, you actually get a higher personal exemption on top of the $6,000. I didn't know that. But so over 65, for those of us that are getting closer and closer to that magic age, we'll get a few more benefits. There's a $10,000 limit on the state and local taxes we talked about. I'm going to show you an idea of how we can increase that actually, so you'll be able to get more deduction than just the $10,000. But we're losing other deductions, and again, if you're not itemizing, you don't get to take and count your charitable deductions. Oh, by the way, the marriage penalty that was been in the tax code forever has largely been taken out, except for the very highest brackets. Used to be if you had a husband and wife, their taxable income is compared to two single individuals making the same income, the married couple would pay more in taxes. That's largely been eliminated under the new tax bill. So here's what you do. You create a family giving fund. How many people give money to charities? Cash gifts. Everybody in the room. Perfect. All right. So how much are you going to give away over the next 3 to 5 years? Well, why don't we put all of that money you're going to give away over the next 3 to 5 years into a family giving fund and deduct it all this year, but give it away over the next 3 to 5 years? Can you do that? Yes. We can create what's called a donor advised fund as part of that 1969 tax bill I was telling you about. Scott, great to meet you. Good luck on the Vistage group. That's terrific.
Thanks for inviting me.
Our pleasure. So it gives you a deduction this year, even though you may not give that money away for the next 1, 2, 3, 4, 5 years. And not only doing that, but why don't you use some appreciated stock or bonds or mutual funds, things that have gone up in value? Why don't you use that to fund this giving fund? You'll get a deduction for the contribution of your appreciated asset, but you won't pay tax on the gain. Talk about a home run, double win. You get a full deduction in most cases. Now, there's a few rules on that, but for the most part, you'll be able to deduct the whole thing this year on assets you've never paid tax on. So, we're going to fly through this one. But by the way, this is a great technique to use, especially if you have real estate. So the fellow I was talking with yesterday, I was chatting, there's a family that has $200 million of real estate. And they're talking about putting that into a private foundation and using it for philanthropy. Wonderful idea, and I encourage them to do that. However, one of the things about a private foundation, if you put real estate into it, what's your deduction? Your deduction's your cost basis. So in other words, if you've got a shopping center and you've depreciated the heck out of it, and you made lots of money because you did it with Damian McKinney, but still your basis is all gone, and you put that into your foundation, you get zero deduction because you depreciated it all out. The only deduction you'll get is just for the value of the land, which is not worth usually in most cases. That may be worth a lot, may not be worth much. But if you use a family giving fund like I just showed you there, your deduction is based on fair market value, not cost basis. And I've got a new client who unfortunately he hired us too late. He had already hired another advisor who set up this private foundation. They put real estate into it, and my client goes, how come I didn't get a deduction for my contribution? Oh, your advisor forgot to tell you that, or maybe didn't know that your deduction is limited to your basis. But if he'd done it with us, so right now we're in the process of opening up this family giving fund for him. Now it's going to be deductible at fair market value. Okay, sorry, got to really fly here. Are you okay if we another 5 minutes? Is this helpful? Are you getting some stuff you can use? It's okay? All right. So how many people have heard of a solo K? How many people have heard of a 401k? Every hand. Solo K is if it's just you. So I've got a husband and wife. They are each self-employed. They have their own separate companies. They're looking at setting up a retirement plan. So all they had known about was a SEP, a Simplified Employee Pension Plan. And the way that works is that basically you get to put away 25% of your earnings into a retirement plan, so pre-tax. Well, the only issue is that that's not as efficient. With a solo K, you can put away the first $18,500 of income of W-2 is 100% deductible. Not 25%, 100%. And on top of that, because they're both over 50, you get another $6,000. So the first $24,500 is deductible immediately, first dollar. Now anything after that, yeah, then we've got some percentage limitations. But you can take and drop your income, your taxable income down substantially, but with the SEP you only get to put away 25%. So at the end of the day, you can still put the same amount of money away, roughly about this year about $55,000. But right now, using a solo K, you can put and accelerate a whole bunch more deductibly. And here's the other thing: is that if you are a husband and wife, you can actually have a single reporting. You can do both separate companies can report on the same $5,500. So it's a way of cutting your costs down, even though they're completely separate companies. Okay, fifth idea, and this one will make your head spin backwards. What's that movie that we never watched, but where the head turns backwards or whatever? Exorcist, yeah, okay, I heard it from, all right. So we're not gonna do an exorcism, but your eyes might go, at least your eyes might cross on this one. How many people have ever heard of reversionary clat, with the exception of Todd? Yeah, I was chatting with a CPA a couple of weeks ago and suggesting this, that we may wanna look at this for a client. And there's this long pause on the phone. He says, a reversionary what? So, a reversionary clat, charitable lead annuity trust. Again, this is another creation of the 1969 Tax Reform Act. Almost 50 years ago, they put a whole bunch of tools in the tax code that nobody uses, that are powerful. Here's one of them. So, it is, it gives, I've got a client right now that's having a situation where they're going to be having exercising stock options. He also has a payout. He was retiring as the president of a bank, so he's getting his stock options. He also has a large amount of money, about $800,000, that's coming out of a deferred compensation plan. So it's all taxable as ordinary income this year, plus his salary. So he's got about $2 million of virtually all ordinary income. So what's he going to do other than pay a whole lot of involuntary philanthropy, also known as income tax? Well, here's an idea for him. So what it does is, and so anytime there's a liquidity event, this is a way we can also offset the gain in that large liquidity event. We just have to do it in the same tax year. Maybe somebody's doing a conversion on their IRA to a Roth IRA. That's one of the changes in the tax law as well, by the way. It used to be that if you converted from an IRA to a Roth IRA, let's say you moved $500,000 out of that IRA into a Roth IRA, that $500,000 is reportable as taxable income this year. But it used to be that you could go all the way till October 15th of the following year and recharacterize and say, you know what, I've changed my mind. I'm going to go back from my Roth IRA, back into my IRA, and that was allowed. Can't do that under the new tax bill. So that's one change also. But it does create you can still do it, but it creates a taxable event. So here's an idea that can help soak up some of that. So here what it is because this is generally something, reversionary means it's coming back to you, okay? I get it back. And the I stands for income. So this is primarily an income tax technique. So you go ahead and create something where you propose, I mean not propose, you actually do. You're going to give money to a not-for-profit so much for so many years. And you commit it up front. Now you can either do it the same dollar amount, or you can do what we call a shark fin, which is where every year it kind of goes up, so it'll look like a shark fin. Okay? So as your income goes up, then your charitable gift goes up. And here's how it looks in real life action. So I've got a client right now, we're doing this, he's made a commitment to do $50,000 a year for the next 10 years to a not-for-profit, which by the way happens to be his own nonprofit. Okay? It's his own family giving fund. So he's going to make a gift to his family giving fund for the next 10 years of $50,000. We're using his stock portfolio, and I made the assumption that if we're getting 2% income on this portfolio and 6% growth, which by the way I can demonstrate how we're doing that, that $550,000, when it comes back to him in 10 years, is going to be worth $463,000, even though we've given away $500,000 worth of charitable donation. Income tax deduction this year is going to be over $422,000. What's not to like about that? So now, the power of this reduces as interest rates go up. So this is an idea to use more now. And this is an idea that it's like the charitable remainder trust. This idea is like that, except it has less armor on it, if you will. Yes, of course, Andrew.
Is there a limit on the 50K a year, or can that be
What meaning?
higher as?
He could. Are you asking? Can he give more than 50,000 a year?
So in this example of a 50K, what's the max you can put in one of these sort of situations?
There's no limit. There are limits on how much you get to deduct in a certain year.
Gotcha.
But absent that, if you want to do 100,000 a year, you want to do $1 million a year. It just, again, it's just whatever, but you have to make it. I mean, you do have to make the payments. I've got a client, we had a huge tax bill, and it was December when I got brought in. And again, we're not CPAs, but what I get brought in to do is to look at business situations. We review their estate planning, we look at their business succession planning, we look at their investments, we look at all those things. But we're the shop where we can talk about all those issues deep and wide. That's what makes us different. And so in this case, for him, they didn't have the cash flow, but what we did is we ended up doing a shark fin clat for them, using some of their own stock of their company as the basis, not the publicly traded stock that we use in this one. We use some of the stock of their own privately held company as the basis for the deduction. So we got them each a $500,000 deduction that year. Okay. So for you, we talked about 5 things. One was a 30-year deferral. Again, if I have to pay my tax, I'd rather pay it 30 years from now than right now. And what we do is we typically will set aside about 5% of the net proceeds to make sure we have enough money to pay the tax in 30 years. We talked about an international private placement contract where we can actually put money into a domicile, either domestic or international, but if we use international, we save about 3.6% on the premium taxes. There's some other benefits. But we can get assets off the radar screen for asset protection reasons, as well as creating some money that can grow without tax and come out without tax as well. We talked about bunching deductions, use a family giving fund, among other things. We also talked about using a solo K instead of a SEP for retirement. So if you're self-employed, this is something we definitely should talk about. And then we talked about an ICLAT as a way of generating something that gives you income tax deductions today. If you have had a big liquidity event this year, we need to talk between now and the end of the year. Please don't wait till December. We get so buried. Now, here's some other quick things. We talked about hiring your kids, your parents, your spouse when you can. Again, that's a terrific way of income shifting, as we would call it. Here's a big one as well. How many people have parents that are 70 or older, or you have a neighbor who's 70 or older, or you're in a not-for-profit and you have friends that are 70 or older? That should cover about everybody. I've got some clients, she's 74, he's 75, and they have a couple $1 million in their profit sharing plan. And I said, well, are you guys even still taking salary? She said, no. So why are you still paying for a profit sharing plan, doing the annual plan administration, and you're not taking a salary? She goes, no good reason. I said, okay. Plus, how much money are you giving away to charity? And between the two of them, they're giving away about $150,000 a year to charity. So what we're doing is we're closing the profit sharing plan, terminating it. We're rolling the money into their own individual IRAs. And if you're 70 and a half or older, you can give up to $100,000 a year out of your IRA to any charity. Did you know that? Up to $100,000 per year per IRA. So if you're in a not-for-profit, you're involved with not-for-profits, and you've got folks that are donors that are at age 70 and a half or older, this is a terrific way. It's good for them, and trust me, it's good for your organization as well. So that's a big one. Interest is actually still deductible on your home equity line of credit. That did change, but if you use that home equity line the way it was originally intended, which is for improving your home, or either buy, build, or substantially improve the home, you get to still deduct the interest for it. So if you hear that you can't deduct your home equity line of interest, that's not completely true. The other thing, if you've had a liquidity event, if you sold an asset, and again, if you've had $500,000 of taxable gain or more, let's talk between now as soon as possible, because there's some ways we can do a tax recovery plan. It's better to have a fence at the top of the cliff. If you're going around a corner, it's better to have a fence at the top of the cliff. But if you've already gone over that cliff, wouldn't you like to know there's an ambulance in the valley? Okay, we can still do a tax recovery plan. But it's better if you've got an upcoming liquidity event, better if we put the fence in place. And if you're not taking advantage of the home office deduction, you are missing $5,000 to $10,000 of tax deductions right there. Home office-based deduction, yes, you can have a home office, and yes, unreimbursed employee expenses did change on the tax bill, but what didn't change is that if you are self-employed, or you can have a reason to have a home office, which basically every one of us today can get it. Even if you work for another company, your company can write you a letter, which I can give you a sample of, telling you that you need to have a home-based office. And therefore you can take deductions for that, but the other big part is that every mile that you leave from your home is going to be deductible for contemporaneous. You also need to be contemporaneous mileage logs, which means you need to keep track of your mileage for the first 3 months of the year. That's what we do. First 3 months of the year, track it, everything, and then from that point on, we just extrapolate for the rest of the year. But you've got to have records for that. But it means that every mile, when I leave my office number 1 to go to my office number 2, is deductible as business miles, not commuting miles. All right, so anyway, that's stuff you can get if you want copies of any of our presentations, you can let us know. Thank you for your kind attention. Thanks for letting us go a few minutes overtime on this. Go make a lasting memory. And I want to thank again our wonderful speakers, Steve Troop, Mark Nielsen, and of course, Councilmember Chris Kate. I'm RJ Kelly. Thanks for being with us.